It's an old saying, the gift of life can be enjoyed only if life is lived with alertness and awareness, which means one who stays awake benefits and the one who sleeps loses out on the benefits. This principle applies to investments in mutual funds as well. If you start investing early, you will remain in profit. But if you keep thinking whether you should invest now or later, you will keep losing opportunities. Starting your investment early helps compound interest multiply and your earnings manifold. You earn interest on the principal investment, then you earn interest on both the principal and the interest amount. This way, interest upon interest gets compounded. This keeps increasing your principal amount. So, what's the cost of delay in your investment through systematic investment plan or SIPs? Let's find out in 9 points. First, let's understand what SIP is. Well, SIP allows you to invest a fixed amount every month in mutual funds in a disciplined manner. Most people invest in equity schemes through SIPs. In SIPs, even if you start with a small amount of investment, with the magic of compounding, it can grow significantly. So, how does SIPs work? SIP is designed in a special way. When the market is at high levels, you get fewer units on your investment. When there is a downturn in the market, you will get more units. This helps average out the cost of investment, leading to better returns. However, there is no guarantee of fixed returns in mutual funds. Thanks to all these advantages, mutual funds have emerged as an excellent option for investment. You can choose the option of time horizon and risk according to your convenience for investment. Due to these advantages, a large number of investors are attracted towards mutual funds. One such feature is goal-based investment. Hemant Rustagi, CEO of Wise Invest, says that starting investment in mutual funds early makes it easier to achieve long-term goals like children's education and retirement planning. For taking advantage of the real potential of asset classes like equity, investment should have a long-term perspective. The power of compounding plays an important role in mutual fund investment, while delaying investment proves to be expensive. For example, 30-year-old Rahul invests 5,000 rupees per month through SIP in equity funds. Assuming an average annual return of 12%, he can accumulate a corpus of 1.77 crore rupees by retirement in the next 30 years. If he starts investing after 10 years, that is at the age of 40, he will only be able to accumulate a fund of 50 lakh rupees in the next 20 years. This example clearly shows that the sooner you start, the more your investment will grow. Along with early investment, it's also important to keep a long-term perspective. It's not possible to determine when the stock market is at peak or at lower levels. In such a scenario, investors should consider investing for a period of more than 5 years. Your investment cost is averaged when you continue to invest in SIP at both high and low net asset values, meaning at both price levels. It's important to understand that no one knows how the market will behave for sure. In such a scenario, there is no right time to start or stop SIP. So, whenever possible, considering your goals, you should start your SIP. However, it's crucial to understand the risks before investing. The higher the expected return in an investment, the higher the risk associated with it. Mutual fund investment is subject to market risks. To understand the risks associated with the funds, carefully read all the scheme's related documents or seek help from a financial advisor. Starting investment early gives you more time to explore various funds. It helps you formulate strategies according to your risk tolerance. If a fund doesn't perform well, you get the opportunity to exit. If you're unable to assess your risk appetite and investment goals, you must seek help from a financial planner.